Let's bring in Bryant VanCronkhite, who's a senior portfolio manager at Allspring Global Investments, joining our conversation this afternoon. One of the things that stands out to me, Bryant, is from the staples category. Some of those stocks are working. Should we be thinking about more traditional type of safety plays instead of the rip-roaring growth trades that have been working up until this point?
I think we need to be more thoughtful about defense within our portfolios today. It used to be simple. It used to be buy utilities, buy staples, buy healthcare, the categories that had relatively stable demand functions. But the reality is those companies and those stocks more in particular are very tied to the movement of interest rates. As interest rates go higher, it's very challenging for utility stocks to outperform, for the stable REIT stocks to outperform, and even for the staple stocks to outperform. And so we need to be thoughtful about where we play defense. I think software and services is a unique place to go right now, and that whole part of the Mag 7 trade is about that. There's certainty of demand. So what I would encourage people to do is not think about the traditional way of playing defense, but think about the microeconomic way. Think about the businesses that have unique, stable demand with low sensitivity to interest rates. And I'm seeing that in places that you have infrastructure spending, like a Vulcan Materials, for example. I'm seeing it in areas like tech as well. So be thoughtful, be reflective, not of the past, but of what's happening in front of our eyes and in the future.
Stocks are down across the board, but Nvidia's up, Meta's up. Do those companies in their growth qualify them as defensive trades? Because we see this a lot, and it seems to be increasing. Unless we have real risk off, these companies manage to find a way through it. Does that make sense to you?
It does make sense to me because they're not so tied to the movement of interest rates. The Fed's toolbox is relatively limited. They want to move rates around to control the flow of money and to increase the sensitivity to people spending capital. But the Metas of the world, the Alphabets of the world, the Microsoft of the world, their balance sheets have massive amounts of net cash. They don't really care if interest rates go up by 100 basis points or 200 basis points. They have clear demand visibility, and they're going to spend to get ahead of the next cycle within their industries. And so I think those businesses have clear demand. They're going to keep spending. They're going to keep investing and growing their earnings and their cash flow. So in a very unique way, their lack of sensitivity to the Fed is a major issue for the Fed because that spending cycle will continue regardless of where rates are. I think it does make sense that they are defensive right now.
Very interesting. Now, what about the consumer stuff that's a little bit more linked to some of those inflationary forces? Do we see this happening because the economy is strong and this inflation is just kind of an inconvenient offshoot, or do we start to see real strain break us down?
I think first and foremost there's real fear, right? We see the small business sentiment index at its lowest point in 12 years. Small businesses drive the U.S. economy. They drive labor, and they're fearful because inflation is still biting at their profitability. You see consumers beginning to pull back on their spending. They are sensitive to rates. They do use leverage for houses and for autos and for big purchases. Credit cards are maxed out with interest rates that are 10 percentage points higher than they were prior to the pandemic. Consumers are making challenging decisions right now. They're trading down in their basket size. They're moving from branded to private label. They probably spent their last vacation dollars in this last spring break, and they're maybe not rebooking going forward. So I think one of the biggest bull dynamics over the last several quarters was the consumer willing to spend. But I think they're getting fearful now, and they're worried that inflation will continue to eat away at their spending power. So I do think the consumer is beginning to crack, and I'm worried that we're starting to lose one of our last great pushes for strength in the U.S. economy.
There are a few consumer stocks that you do like, just to get real specific, no more than like 30 seconds on each. But tell me about Reynolds, which is kind of a traditional staple. LKQ is an interesting discretionary vehicle-related company that I'm curious in particular about, given some of the very interesting dynamics within autos lately.
Let's start there with LKQ. It's an interesting business in that it's a discretionary stock by definition, but the reality is the demand for their products, which is replacement parts for autos, is very stable. It's especially true that demand picks up when the consumer needs to pull back on branded parts. So if you're in an accident, need to repair your vehicle, you have the branded part, which is more expensive than the refurbished or private label part, which LKQ makes. LKQ's stock, though, was impacted by a large acquisition they made a few quarters ago, and they're just beginning to integrate it now. I think the market overreacted to that transaction. I think it could be a very good deal for them as they integrate those new assets into their business. And so the cash flow, I think, is underappreciated. The demand function remains stable, and it's going to act like a staple despite being tied to what I consider the discretionary auto bucket.
I like that. Okay, interesting. Because we certainly have seen some slowdown in some of the broad auto sales, but then like a little bit of a pivot into some of the ICE vehicles and hybrids away from the EVs. So maybe a broad kind of autos trade still has some of that resilience built into it. As far as the more cyclical kind of traditional trades, how much confidence do you have there? Because it seemed like you're getting a little bit worried about some of the consumers slow down into a pinch. Does that mean you need to avoid more traditional discretionary businesses?
I think you want to be more thoughtful about where you get your consumer exposure. So definitely I'm pushing for an overweight to staples, underweight discretionary. But there are pockets of the economy that I think are cyclical by their very nature, but grossly undervalued today. And I point to CBRE as a unique opportunity. The market's reacting very predictably today, down 5%. It's a business that has a portion of their cash flow tied to very stable building maintenance, but a portion that's significantly tied to transaction volumes of commercial real estate. And that has dried up as rates have moved higher, and the market's being very predictable today, pushing that stock down. But the reality is they have a great balance sheet and they're investing through this cycle. Volumes will pick up in commercial real estate transactions, especially when people get to a point of max stress, max pain, and they have to refinance their current debt on those buildings. I like CBRE as an offensive way to play even in a higher rate environment. And if rates do fall, I think it's an absolutely great spot to put capital today.
Fascinating. Okay. I like it. Thanks for the specifics, Bryant. Fun conversation. Like to work in some of the stock angles there on a very macro day. Appreciate your time.
My pleasure.
Bryant VanCronkhite, Senior Portfolio Manager at Allspring Global Investments.